They told me removing a CFO required board consensus, shareholder supermajority, and public disclosure. They were wrong. It required none of those things. It just required knowing which questions couldn't be answered. The audit committee met on the third Tuesday of every month at 7:30 a.m. in conference room B. I knew this because I'd scheduled these meetings for 3 years when I was Julian's assistant, had blocked the time on his calendar, had prepared the agenda materials, had ordered the breakfast service that no one ate because audit committees didn't convene to enjoy pastries. But I'd never attended one. Assistants didn't attend audit committees, even executive assistants. Even assistants who understood what EBITDA meant and could read a cash flow statement and had caught a decimal point error that would have destroyed a $340 million acquisition. Assistants observed from outside, took notes when asked, retrieved documents when needed, existed as infrastructure, not participants. Principals attended. I walked into conference room B at 7:28 a.m. carrying the briefcase Daniel had prepared for me. Inside, the last 6 quarters of financial statements, the most recent 10Q, the preliminary Pemberton and Ross findings, and a single-page summary I'd written at 5:47 a.m. this morning, outlining 3 areas I wanted to understand better. Not accusations, not demands, just areas requiring familiarity. The room smelled like coffee that had been sitting too long and the particular staleness of air conditioning that had been running since 6 a.m. The conference table was smaller than the boardroom table, only 8 chairs instead of 12. The windows faced north instead of south, which meant less natural light, which meant the overhead fluorescents were already on, even though the sun had been up for 90 minutes. 3 people were already seated when I entered. Thomas Wright, CFO, 63, gray hair, wire-rimmed glasses. The same man who'd bought me coffee 3 weeks ago and warned me that power flowed from relationships, not ownership. He looked up when I entered, nodded, professional courtesy, the acknowledgement you give to someone whose presence is expected. Margaret CO, head of corporate strategy, 51, Stanford MBA. The only other woman on the board before I'd arrived, she was reviewing something on her tablet, looked up when I entered, smiled briefly, the professional greeting that acknowledged arrival without interrupting workflow. David Chen, general counsel, 47, Princeton undergrad, Yale Law. He was pouring coffee from the carafe on the saw me, smiled. Elena, welcome. Coffee? Thank you, I said. I moved to the credenza, poured coffee I didn't particularly want, the ritual of participation. I took the empty chair between Margaret and David. Not at the head of the table, Thomas sat there as CFO and committee chair. Not at the far end, that seat was still empty, presumably for whoever else was joining. But in the middle. Present. Positioned. Thomas checked his watch. We're expecting Julian at 7:30. He usually observes the first 30 minutes before excusing himself. Observes, I repeated. The CEO typically doesn't participate in audit committee discussions, Thomas said. Conflict of interest. We're here to review management's financial reporting. Julian is management, so he observes, answers questions if needed, then leaves so we can deliberate. I nodded. Standard governance practice. The audit committee existed to provide independent oversight of financial reporting and internal controls. The CEO's presence would compromise that independence. And the external auditor? I asked. Deloitte joins us quarterly, Margaret said. This is an off-quarter meeting. Internal review only. Requested by you, Thomas added, looking at me. Per your email last week asking to be added to the committee. Yes, I said. Standard principal access, Thomas said. Section 7.4. You have every right to be here. The phrasing was neutral, welcoming even. But something in the construction, every right to be here, suggested the statement had been prepared, had been discussed, had been approved as the official position on my attendance. Julian arrived at 7:31 a.m. He walked into conference room B with his usual rhythm, Italian leather on linoleum, the percussion of arrival. He was wearing a navy suit, white shirt, no tie yet, that would come later, before whatever meetings filled his morning calendar. He nodded to the room generally. Morning. Morning, Julian, Thomas said. We're just getting started. Julian took the empty chair at the far end of the table, set down his phone, folded his hands, the posture of observation. Thomas pulled up something on his laptop. The screen mirrored to the display at the front of the room. a spreadsheet, columns of numbers, the aesthetic of financial reporting, precision and density, and the assumption that anyone looking at it knew what they were looking at. "We're reviewing Q3 actuals versus budget," Thomas said. "Overall performance is strong. Revenue up 7% year over year. EBITDA margins at 32.8%, which is above our 32% target. Cash flow from operations is healthy. No significant variances that require discussion." He clicked to the next slide. "Operating expenses are tracking 3% under budget, which is favorable. CapEx is on plan. Working capital metrics are stable." Another click. "We have one budget variance flagged by the internal audit team, professional services line. We budgeted $2.1 million-ish for Q3. Actual spend was $2.7 million. That's a $600,000 overrun." I looked at the slide, focused on the line item professional services, external consultants. Budget $2.1 million, actual $2.7 million, variance $600K, unfavorable. "What category is that?" Margaret asked. Thomas clicked to a detail page. A table appeared showing the breakdown. Blackwood Strategic Partners, $125. McKinsey & Company, $340K. Bain & Company, $180K. Miscellaneous advisors, $55K. Total, $700K. I stared at the first line. Blackwood Strategic Partners, $125. Arthur's entity, the consulting agreement from 2012, the one that had paid him $1.5 million over 3 years, the one I'd found in the Gregory Vance files. "Blackwood Strategic Partners," Margaret said. "That's the legacy advisory relationship?" Thomas nodded. "Correct. Long-standing engagement, strategic guidance on corporate development." I said nothing, just observed. Noted that the payment had occurred this quarter. Noted that no one in the room appeared to find this remarkable. "The other consultants are for the competitive analysis work we discussed in August," Thomas continued. "Standard strategic planning support." He moved to the next slide. "Internal controls update. We had one control observation this quarter, related to the reconciliation process for intercompany transactions." He clicked to a new slide. "Our internal audit team noted that intercompany balances between the parent company and 3 subsidiaries weren't being reconciled monthly as required by our accounting policies. The reconciliations were being performed quarterly instead." "What's the magnitude?" Margaret asked. Thomas pulled up another page. "The balances range from $5 million to $30 million depending on the subsidiary. Total intercompany exposure is approximately $85 million. I made a note, not because I needed to remember, but because principals made notes during audit committee meetings. It was expected behavior." "Has this been addressed?" David asked. "Yes," Thomas said. "We've restored the monthly cadence as of October 1st. We're also conducting a retrospective review of Q2 and Q3 to confirm there were no material discrepancies during the quarterly reconciliation period." "Timeline for that review?" Margaret asked. "End of November." Thomas said, "We'll report findings at the December meeting." Standard governance language, professional, procedural, the kind of update that acknowledged an observation without characterizing it as failure. I watched Thomas present, noted how he framed the reconciliation gap, quarterly instead of monthly. Not missed or failed or inadequate, just a description of frequency, a difference in timing, not a difference in quality. The language was careful, precise. The rest of the meeting proceeded without incident. Risk assessment updates, compliance certification, external audit planning for year-end. At 8:47 a.m., Thomas adjourned the meeting. Julian stood, left without speaking. Margaret gathered her materials, said something to David about a compliance matter they needed to discuss. Thomas closed his laptop with deliberate precision. I stayed seated. Thomas noticed. "Something else, Elena?" "Just getting oriented," I said. "I'd like to understand the Blackwood Strategic Partners engagement better. Where would I find the underlying contract?" "Accounting has the master file," Thomas said. "I can have them send it to you." "Thank you," I said. "And the deliverables from this quarter?" "Those would be with corporate strategy," Margaret said. She'd paused near the door. "I'll have Sarah send them over." "I appreciate that," I said. They left. I sat alone in conference room B and thought about what I'd just observed. Blackwood Strategic Partners had been paid $125,000 this quarter, 3 months ago, July through September, during a period when Arthur had been incapacitated, when Arthur couldn't have performed consulting work, when Arthur's entity should have been dormant. But the payment had been made, had been budgeted, had been reported to the audit committee as routine, which meant either A, someone was still operating the entity, or B, the payments were continuing for reasons other than active consulting. Thomas had described it as a long-standing engagement, had used present tense. Strategic guidance on corporate development, as if the relationship were ongoing, active, current, but he hadn't specified who was providing that guidance now that Arthur couldn't. The intercompany reconciliation issue was different, more procedural, more clearly within normal operational variance. Monthly reconciliations had become quarterly reconciliations, resources had been constrained, the frequency had changed, but the reconciliations had still been performed, just less often. Thomas had framed it as a process observation, not a control failure, not a risk exposure, just a timing variance that internal audit had flagged and management had corrected. But $85 million in balances going unreconciled for up to 3 months wasn't timing variance, it was exposure. The kind of exposure that created space for errors to exist undetected, for adjustments to be made between reconciliation cycles, for numbers to be managed in ways that monthly scrutiny would catch but quarterly scrutiny might not. And the timing was interesting. The quarterly reconciliations had been in place during Q2 and Q3, April through September, the exact period leading up to the Pemberton and Ross audit launch. The monthly reconciliations had been restored October 1st, the day after the audit was announced, which could be coincidence, could be good governance, could be normal management response to an internal audit finding, or could be something else. I pulled out my phone, opened my secure notes, started typing. Observations requiring follow-up. 1. Blackwood Strategic Partners payment process Q3 2024. Who received it? Who authorized it? What entity structure exists now? 2. Intercompany reconciliation frequency changed Q2 Q3. Restored October 1s. What subsidiaries? What balances? What transactions occurred during quarterly-only period? 3. Thomas frames both items as procedurally normal. Language is defensive without appearing defensive. Suggests preparation. I stared at the third note, tried to determine what it meant. Thomas Wright had been CFO for 16 years, had worked under Gregory, had transitioned to Julian, had signed off on hundreds of transactions, dozens of acquisitions, thousands of financial decisions. He was competent, experienced, the kind of CFO who knew how to present information in ways that answered questions without inviting follow-up questions. The kind of CFO who understood that framing mattered. That language created reality. That quarterly reconciliations sounded more defensible than reconciliations not performed monthly as required. But I didn't yet know whether that carefulness was professional habit or strategic protection. I returned to my office and spent the next 2 hours reading. First, the Blackwood Strategic Partners contract. Accounting had sent it over within 30 minutes of my request. The document was dated November 8, 2012, between Vance Global and Blackwood Strategic Partners, LLC. Scope of work: strategic advisory services, including but not limited to merger evaluation, corporate governance review, and competitive analysis. Term: 3 years with automatic renewal unless terminated by either party with 90 days notice. Compensation: $125,000 per quarter. I read the renewal clause twice. Automatic renewal, which meant the contract had continued past 2015 unless someone had actively terminated it. And based on this quarter's payment, no one had. The signature block showed Thomas Wright signing for Vance Global, Arthur Blackwood signing for Blackwood Strategic Partners. No board approval noted, no conflict of interest disclosure, just a management-level consulting agreement that happened to be with a 40% shareholder. Second, the deliverables from Q3. Margaret's assistant had sent 3 documents: a competitive landscape analysis dated July 15, 16 pages, professional formatting, generic strategic language about market trends and competitive positioning, the kind of document that could have been produced by any consultant with access to public information and basic industry knowledge. A strategic planning memo dated August 22nd, 8 pages, recommendations for Q4 priorities, nothing specific, nothing that required insider knowledge, nothing that suggested the author had particular expertise or access. A market assessment report dated September 30th, 22 pages, analysis of industry dynamics and growth opportunities. Well written, competent, unremarkable. All 3 documents were formatted identically. Same font, same header, same footer showing Blackwood Strategic Partners LLC Confidential. But none showed an author. None had a signature. None indicated who had actually written them. I opened my laptop and searched for Blackwood Strategic Partners LLC. Found a business registration in Delaware. Registered agent, corporation service company. A standard corporate services firm that provided registered agent services for thousands of entities. No website, no phone number, no employee listings, no press mentions, nothing that indicated the entity had any operational existence beyond its legal registration, which meant either A, it was a shell company that had always been a shell company, or B, it had been operational when Arthur was active and had become a shell after his incapacitation. But if it was a shell now, who was producing the quarterly deliverables? Who was receiving the quarterly payments? Who was maintaining the appearance of an active consulting relationship? I pulled up the intercompany reconciliation information next. Thomas had sent summary data showing the 3 subsidiaries with material balances. Vance Global Holdings LLC, Hexagon Media Corporation, $30. Hexagon Media Corporation, the acquisition from 8 months ago, the one I'd corrected, the one currently under audit. I opened the Hexagon file, reviewed the acquisition structure. Hexagon had been acquired as a wholly owned subsidiary. Parent company had advanced $30 million in working capital post-acquisition to support operations during integration. That $30 million was sitting as an intercompany receivable on the parent company's books, an asset, money owed by Hexagon to Vance Global. Except intercompany balances weren't really assets, they were accounting mechanisms. They netted to zero when you consolidated the financial statements. They only mattered for tax purposes and for tracking cash flows between legal entities. But they created space for transactions to move between entities, space for timing differences, space for adjustments that affected individual legal entities, even if they netted out at the consolidated level. And if those balances weren't being reconciled monthly, if they were only being reviewed quarterly, then that space expanded, became 3 months wide instead of 1 month wide. I closed the file and sat in my office thinking about space and timing, and what could exist in gaps that were designed to be temporary but might not be. I didn't have proof of anything, didn't have evidence of wrongdoing, didn't have a smoking gun. What I had was observation, pattern recognition, the sense that language was being managed, that information was being presented in ways that were defensible and procedurally sound and technically accurate but incomplete. I had access now. Audit committee membership, the right to ask questions, the right to receive materials, but I didn't yet have the map. Didn't know which questions would reveal structure versus which would reveal resistance. Didn't know whether Thomas was managing information because that was his job or because that was his defense. The only way to know was to keep observing, keep requesting, keep positioning myself in places where information flowed and see what flowed differently when I was there versus when I wasn't. I pulled up my calendar. The next audit committee meeting was in 4 weeks, December 17. 4 weeks to understand what the retrospective reconciliation review would find. 4 weeks to map who was operating Blackwood Strategic Partners. 4 weeks to determine whether I was looking at careful governance or careful concealment. I made a note to request the reconciliation work papers once the November review was complete. Then I closed my laptop and looked out the window at Manhattan operating below me. Somewhere in this building, or in the accounting systems, or in the intercompany transactions between parent and subsidiary, there was information that would answer my questions. But information didn't reveal itself. It had to be extracted through process, through patience, through positioning myself where the gaps became visible. I was positioned now. The question was what I would see once I knew where to look. The Blackwood Strategic Partners file arrived at 2:47 p.m. on Wednesday, 3 days after I'd requested it. Not from accounting, from legal operations. The email was from Amanda Reyes, the same associate general counsel who'd provided me with sanitized Hexagon materials 5 weeks ago. Subject line, Blackwood Strategic Partners documentation review complete. I opened it. Elena, per your request, please find attached the Blackwood Strategic Partners Master Agreement and related amendments. Please note that certain exhibits have been redacted pursuant to attorney-client privilege and proprietary information protections. If you have questions about the redactions, please coordinate with David Chen's office. Amanda, I downloaded the attachment, a PDF, 47 pages. The contract itself was 12 pages, the same document I'd already reviewed, dated November 8th, 2012, signed by Thomas Wright and Arthur Blackwood. Scope of work, compensation terms, renewal provisions, nothing new. Pages 13 through 23 were labeled Exhibit A, detailed scope of services. But the content was almost entirely redacted, black boxes covering everything except headers and page numbers. Occasional fragments visible, competitive analysis methodology, and proprietary frameworks for, the rest redacted. Pages 24 through 31 were labeled Exhibit B, deliverable standards and quality metrics. Also heavily redacted, maybe 20% visible. The rest replaced with black rectangles and the notation, redacted per privilege. Pages 32 through 47 were invoices, quarterly, dating back to 2012, each showing the same information: date, invoice number, BSP year, Q number, description, strategic advisory services per master agreement, amount $125,000. Payment status paid. No detail about what services had been provided. No breakdown of hours or deliverables, just a quarterly invoice for the contracted amount, paid within 30 days of each quarter end, every quarter, for 12 years, including Q3 2024, 3 months ago. When Arthur had been incapacitated for 18 months, I pulled up my email and started typing. Amanda, thank you for providing the file. I have questions about the redactions. 1. What is the basis for claiming attorney-client privilege over the scope of work and deliverable standards? These appear to be commercial terms, not legal advice. 2. Who is the client for purposes of the privilege claim? 3. Can you provide the privilege log showing what was redacted and why? Elena, I sent it at 2:54 p.m. At 3:17 p.m. I received a response. Not from Amanda, from David Chen. Elena, Amanda forwarded me your questions about the Blackwood Strategic Partners redactions. I'd like to discuss this by phone rather than email. Are you available at 4 p.m. today? David. Which meant the questions had triggered escalation, had moved from legal operations to general counsel, had been flagged as requiring management rather than routine response. I replied, yes, I'll call you at 4. At 4 p.m. I dialed David's extension. He answered on the first ring. Elena, thanks for making time. Of course, I said. I wanted to talk about the Blackwood materials, David said. His voice had the careful neutrality of someone who'd prepared for this conversation. The redactions are necessary to protect confidential commercial information and strategic methodologies that Blackwood Strategic developed specifically for Vance Global. Developed, I repeated. Past tense or present tense. A pause. The methodologies were developed during the active consulting relationship. Which ended when, I asked. The contract remains active, David said. The relationship is ongoing. Arthur Blackwood has advanced dementia, I said. He's been incapacitated for 18 months. Who's performing the consulting work? Another pause. Longer this time. The entity continues to operate, David said. They have resources who maintain the relationship and deliver the contractual services. What resources? I asked. That's internal to their organization, David said. We contract with the entity, not with specific individuals. I'd like to know who's operating the entity, I said. That would require direct inquiry with Blackwood Strategic, David said. We don't have visibility into their operational structure. I made a note. The response was technically accurate, legally defensible, and completely uninformative about the actual question. The invoices show quarterly payments through Q3 2024, I said. Each invoice is identical, same amount, same description, no detail about services provided. How does finance verify that the services were actually delivered before processing payment? The deliverables are reviewed by corporate strategy, David said. Margaret CEO's team confirms receipt and quality before invoices are approved. And the deliverables from Q3, I asked. The 3 documents Margaret sent me, they show no author, no signature, no indication of who produced them. How do we know they came from Blackwood Strategic? They're submitted through the established communication channel, David said. We have a secure file transfer protocol that Blackwood Strategic has used since the engagement began. Who has access to that protocol? I asked. I'd have to check with IT, David said. I'd like you to check, I said. Silence. Not long, maybe 3 seconds, but long enough that I could hear him calculating. Elena, he said carefully, I understand you're conducting due diligence on various company relationships. That's appropriate for a principal. But I want to flag that some of these questions might be better addressed through formal audit channels rather than ad hoc information requests. The audit is focused on Hexagon, I said. This is a different matter. It may become an audit matter if you believe there are issues with this relationship, David said. And if that's the case, we should coordinate with Pemberton and Ross to ensure any investigation is properly structured and legally protected. Which was a polite way of saying, stop asking questions informally and either drop it or make it official. I said nothing for a moment. Let the silence do its work. I'll consider that, I said finally. In the meantime, I'd like the IT information about the file transfer protocol access. I'll have someone look into it, David said. We ended the call. I sat in my office and thought about what I'd just heard. David had escalated from document provision to conversation, had framed my questions as requiring coordination with audit channels, had suggested that continuing to inquire might trigger formal investigation procedures, which meant either A, he was genuinely concerned about process integrity, or B, he was establishing procedural barriers to slow down information access. Either way, the effect was the same: delay, redirection, the introduction of process where simple answers should have been sufficient. The intercompany reconciliation work papers arrived on Friday at 4:47 p.m., 2 days after I'd requested them, late enough on Friday that follow-up questions would have to wait until Monday. The email was from someone I didn't know, Kevin Park. Title: Senior Manager, Financial Reporting. Subject line: Intercompany Reconciliation Review, Q2, Q3 2024. Ms. Chen, attached, please find the summary findings from our retrospective review of intercompany balances for Q2 and Q3 2024. Per our discussion at the November 19th Audit Committee meeting, this review was conducted to validate that no material discrepancies existed during the period when monthly reconciliations were not performed. Please note that detailed work papers are maintained in finance and are available for review upon request through proper channels. Kevin Park, Senior Manager, Financial Reporting. I opened the attachment, a single Excel file, one tab labeled Summary. The summary showed 3 subsidiaries and their intercompany balances: Vance Global Holdings LLC, Q2 beginning balance $4.8 million, Q activity plus $0.3 million, Q2 ending balance $5.1, reconciliation status, no discrepancies identified, Vance Media Services Inc., Q2 beginning balance $21.4 million, Q2 activity plus $0.8 million, Q2 ending balance $22.2, reconciliation status, no discrepancies identified. Hexagon Media Corporation Q2 beginning balance $28.7, Q2 activity $2.1 M balance, 32 ending balance, reconciliation status, no discrepancies identified. Similar entries for Q3. Same format, same conclusion, no discrepancies identified. Clean, complete, uninformative. The summary showed balances and activity but didn't show what the activity was, didn't show what transactions had moved money between parent and subsidiary, didn't show timing, didn't show purpose, just activity occurred. Balances changed, no discrepancies identified. I pulled up my email and replied to Kevin Park. Kevin, thank you for the summary. I'd like to review the detailed work papers. Specifically 1, transaction level detail for Q2 and Q3 activity. 2, the reconciliation methodology used in the retrospective review. 3, any reconciling items or timing differences that were identified and resolved. When can I schedule time to review these materials? Elena, I sent it at 4:52 p.m. At 4:58 p.m., Kevin replied. Ms. Chen, the detailed work papers contain confidential operational information about subsidiary cash management and working capital strategies. Access to these materials requires approval from the CFO's office per our financial information access protocols. I've copied Thomas Wright on this email to facilitate the approval process. Kevin Thomas Wright was now copied, which meant my request for transaction detail had been escalated to the CFO, had been flagged as requiring his approval before I could access information about how money moved between corporate entities. I looked at the time, 4:59 p.m. on a Friday. Thomas wouldn't respond until Monday at the earliest, which meant the weekend would pass, which meant any follow-up would be delayed by at least 3 days. I closed my email and opened the intercompany summary again. Studied the numbers. Hexagon Media Corporation's balance had increased from $28.7 million to $30.8 million during Q2, an increase of $2.1 million, which meant the parent company had advanced an additional $2.1 million to Hexagon during the quarter. But the Hexagon acquisition had closed in January, 5 months before Q2, which meant this wasn't initial acquisition funding. This was post-acquisition cash movement, which was normal. Parent companies routinely advanced working capital to subsidiaries, supported operations, funded growth initiatives. But $2.1 million in additional funding during Q2, the same quarter when Hexagon's financials were presumably being integrated and stabilized, seemed like more than routine working capital support. And the timing was interesting. Q2 was April through June. The Pemberton and Ross audit had been announced in September, which meant this activity had occurred 3 months before the audit started. 3 months before anyone outside management knew there would be scrutiny of the Hexagon acquisition. But management had known. Thomas had known. The board had voted to approve my audit proposal in September, but the discussion had been happening internally for weeks before that. Which meant it was possible, not certain, but possible, that by Q2, people who understood how audits worked would have known one was coming, would have known that Hexagon would be examined, would have had time to make adjustments, to clean things up, to move things around, if there were things that needed moving. I closed the file and made a note. Timeline question. When did management first discuss the possibility of a Hexagon audit? When did Thomas know? What decisions were made in Q2 that might have been influenced by anticipated scrutiny? I didn't have answers, didn't have evidence, just the sense that timing mattered, that sequence mattered, that the space between when something was decided and when it was disclosed created opportunities for preparation. On Monday at 9:17 a.m., I received an email from Thomas Wright, subject line, re-intercompany workpaper access. Elena, Kevin Park forwarded me your request for detailed intercompany transaction workpapers. I want to make sure we handle this appropriately. These workpapers contain sensitive operational information about cash management, vendor payments, and working capital strategies across our subsidiary structure. This information is typically restricted to finance leadership and external auditors under NDA. I'm not saying you can't review them. You have audit committee membership and principal rights. But I want to discuss the appropriate framework for access, including any confidentiality protocols we should establish before providing materials of this sensitivity. Can we schedule a call this week? I'm available Tuesday afternoon or Thursday morning. Thomas, I read it twice. The language was careful, respectful, acknowledged my rights while introducing process, framed the work papers as sensitive without saying I couldn't see them, suggested a conversation instead of simply providing access. It was resistance disguised as appropriate governance. I replied at 9:23 a.m. Thomas, I'm available Tuesday at 2 p.m. I appreciate your attention to confidentiality protocols. However, I want to clarify that as an audit committee member and 40% shareholder, I have the same access rights as external auditors. I'm not requesting these materials for competitive purposes or external disclosure. I'm conducting oversight of financial controls and reporting processes, which is exactly what audit committee membership is designed to enable. I look forward to our discussion Tuesday. Elena, I sent it and sat back. The pattern was clear now. Every request I made triggered process. Every document I asked for introduced delay. Every question I posed escalated to someone who wanted to discuss appropriate frameworks and confidentiality protocols and whether my inquiry should be routed through formal audit channels. No one was saying no. No one was blocking me overtly, but no one was simply providing information either. Instead, conversation, coordination, framework establishment, approval processes. The effect was the same as refusal, just more defensible. The call with Thomas on Tuesday lasted 37 minutes. He began by acknowledging my access rights, confirmed that as an audit committee member, I had legitimate authority to review financial documentation, agreed that oversight of intercompany controls fell within appropriate principal responsibilities. Then he spent the next 20 minutes explaining why the detailed work papers were complex, technical, and potentially confusing without proper context. The intercompany reconciliations involve dozens of transaction types, Thomas said. Cash advances, overhead allocations, management fees, shared service charges. Some are recurring, some are one-time, some involve multiple entities. Without understanding our cash management policies and transfer pricing methodologies, the raw transaction detail might raise questions that have straightforward operational explanations. I'd like to see the detail and form my own questions, I said. Of course, Thomas said. I'm just suggesting it might be more efficient if we walked through the reconciliation framework together first. That way you'll have context for what you're looking at. When can we schedule that walkthrough, I asked. I'd need to coordinate with Kevin Park, Thomas said, and probably bring in someone from Treasury who manages the day-to-day cash movements. Let me check calendars and get back to you. This week? I asked. Probably next week, Thomas said. Thanksgiving week is challenging with people traveling, maybe the week after. 2 weeks, minimum. We ended the call at 2:37 p.m. I sat in my office and thought about what had just happened. Thomas had agreed to provide access, had acknowledged my rights, had committed to scheduling a walkthrough, but the access had been deferred. The timeline had been extended. The simplicity of "send me the files" had been converted into "let's schedule a multi-person meeting to discuss context first." And that meeting wouldn't happen for 2 weeks, which meant 2 weeks before I saw transaction detail, 2 weeks before I could determine what had actually moved between parent and subsidiary during Q2 and Q3, 2 weeks before I could understand whether the retrospective reconciliation review had been comprehensive or selective. I pulled up my calendar, counted the days. The next audit committee meeting was December 17th, 3 weeks away. If Thomas scheduled the work paper walkthrough for the week after Thanksgiving, that would be early December, which would give me maybe 1 week to review the materials before the audit committee met again, 1 week to understand what I was looking at, 1 week to formulate questions, 1 week to determine whether Thomas's explanation that monthly reconciliations had simply become quarterly reconciliations due to resource constraints was accurate or was careful language covering something else. The timeline was tight, possibly too tight, possibly designed to be too tight. I opened my laptop and pulled up the Vance Global organizational chart, looked at who reported to Thomas, who had access to intercompany work papers, who had authority to approve transactions between parent and subsidiary. Found 3 people: Kevin Park, Senior Manager Financial Reporting, Elena Chen, Director of Treasury, Lisa Nguyen, Analyst Corporate Development. Lisa Nguyen, the analyst who told me about the hexagon financial model assumptions, who'd volunteered information about how Julian changed the projections, who'd established a record that she'd raised concerns, who'd chosen documentation over allegiance. I pulled up my contacts, found Lisa's extension, picked up the phone, put it back down. If I called Lisa directly, I would be signaling that I was trying to route around Thomas, would be creating a record of going to a junior analyst instead of through proper channels, would be doing exactly what Thomas's careful process management was designed to prevent. But if I didn't call Lisa, I would be dependent on Thomas's timeline, would be waiting 2 weeks for a walkthrough that might or might not provide the detail I needed, would be operating at the pace Thomas set rather than the pace oversight required. I sat in my office as afternoon turned to evening and thought about access versus cooperation. I had access, audit committee membership, principal rights, legal authority to request financial documentation, but I didn't have cooperation. Every request triggered process. Every question introduced delay. Every attempt to understand how money moved through the organization encountered frameworks and protocols and appropriate channels. And the distance between access and cooperation was where institutional resistance lived. Not in refusal, not in obstruction, but in process, in timelines, in the transformation of simple questions into complex procedures that required coordination and context and calendaring. I pulled out my phone, opened my secure notes, Added a new entry. Pattern identified. Thomas controls information through process, not denial. Every request is acknowledged, deferred, complicated. Timeline extends. Context requirements increase. Access exists, but utility decreases. Question: is this defensive competence or defensive concealment? Cannot determine without seeing what he's contextualizing. I closed the notes and looked out at Manhattan as the city transitioned from day to evening, lights coming on in buildings, people leaving offices, the daily rhythm of commerce and routine. Somewhere in Thomas Wright's systems, in the intercompany reconciliations, in the transaction detail, in the cash movements between parent and subsidiary, there was information that would answer my questions. But information didn't reveal itself just because you had the right to see it. It revealed itself when the cost of withholding it became greater than the cost of disclosing it. And I hadn't created that cost yet. The intercompany reconciliation work papers arrived on Friday at 9:34 a.m. Not the summary, the detailed work papers, the transaction-level data I'd requested from Thomas Wright 6 days ago. The email was from Kevin Park. Subject line, Intercompany Transaction Detail Q2 Q3 2024. Ms. Chen, per your follow-up request, attached are the detailed transaction listings for the 3 subsidiaries included in the Q2 Q3 retrospective reconciliation review. Please note, this is raw system output and may require context for proper interpretation. Let me know if you have questions. Kevin, I opened the attachment, an Excel file. 3 tabs, 1 for each subsidiary. I clicked on the Hexagon Media Corporation tab first. The spreadsheet showed individual transactions. Date, description, amount, running balance, standard financial system output. The aesthetic of accounting data, dense, technical, precise. Most entries were labeled working capital advance or operating support or cash transfer general. Parent company funding subsidiary operations. Amounts ranging from $50,000 to $300,000, but 3 entries were different. April 18, professional services reclass, $420,000. May 22, expense allocation adjustment, $385,000. June 29, prior period correction, $290,000, total $1,095,000. More than half of the Q2 activity that had increased Hexagon's intercompany balance from $28.7 million to $30.8 million. I stared at the descriptions: professional services reclass, expense allocation adjustment, prior period correction. Generic accounting language, the terminology of journal entries that moved expenses from one place to another without changing consolidated totals. Technical, procedurally defensible, routine in the mechanics of corporate accounting. But the amounts weren't routine, and the timing wasn't routine. I opened a new spreadsheet, started mapping the sequence. April 18th, $420K reclassified from parent to Hexagon. May 22, $385K reclassified from parent to Hexagon. June 29, $290K reclassified from parent to Hexagon, all in Q2. All during the period when monthly reconciliations hadn't been performed. All before the Pemberton and Ross audit had been announced in September. I pulled up the notes section at the bottom of Kevin's spreadsheet. There was a single comment, flagged by the system reviewer. Note, entries April-June represent corrections to properly allocate acquisition-related costs to benefiting entity per management direction. Original costs recorded at parent level, reclassified to subsidiary upon completion of cost allocation analysis. No impact to consolidated P&L. Per management direction. Which management? Who had directed the allocation analysis? Who had decided that expenses originally recorded at the parent company belonged with Hexagon instead? I scrolled to the next column, found what I was looking for: approval codes. Each transaction had a 4-character approval code embedded in the system metadata. April 18th, TW-04, May 22, TW-05, June 29, TW-06, TW, Thomas Wright. I pulled up the financial system user guide, found the approval code reference table, confirmed what I already knew. TW, Thomas Wright, Chief Financial Officer, authorization level, unrestricted. Requires secondary approval? No, for entries under 500K. Thomas had approved all 3 entries, had the authority to do so without secondary review. Had executed the reclassifications during Q2 using system permissions that were appropriate to his role. Nothing unusual, nothing that would trigger audit flags, nothing that violated policy. Just 3 accounting entries moving $1.095 million in expenses from parent company to subsidiary, approved by the CFO, recorded during a quarter when monthly control procedures had been temporarily relaxed. I closed the spreadsheet and thought about what I'd found. Not proof of fraud, not evidence of wrongdoing, just information about how expenses had been reclassified and who had approved those reclassifications and when they had occurred. Information that raised questions, but questions weren't accusations. And pattern recognition wasn't evidence. I pulled up my email and started typing. Thomas, I've received the Q2, Q3 intercompany transaction detail from Kevin. I have questions about 3 specific entries. April 18th, professional services reclass, $420,000. May 22, expense allocation adjustment, $385,000. June 29, prior period correction, $290,000. Can you provide 1, the business justification for these reclassifications? 2, the underlying expense detail showing what was reclassified. 3, the analysis that determined these costs should be allocated to Hexagon. I'd like to understand this before the December Audit Committee meeting. Elena, I read it twice. The language was direct but not accusatory, factual but not hostile. The tone of someone requesting information, not challenging decisions. I sent it at 10:47 a.m. At 2:34 p.m., Thomas called me. Not email, phone call, which meant the questions had triggered immediate response rather than written documentation. Elena, he said when I answered, I got your email about the Q2 entries. Yes, I said. Let me walk you through what happened, Thomas said. His voice was steady, professional, the tone of someone explaining routine procedures. During Q2, we conducted a review of acquisition-related costs. We identified expenses that had been initially recorded at the parent company level, but that should properly be allocated to Hexagon since the subsidiary was the primary beneficiary. What expenses? I asked. Professional services, Thomas said. Advisory and consulting fees related to the acquisition and integration. They were charged to parent company accounts initially because that's where the vendor relationships existed. But after analysis, we determined they should be allocated to the subsidiary. Who conducted that analysis? I asked. Finance, Thomas said. Kevin Park led the review. I approved the allocation methodology. I'd like to see the approval documentation, I said, and the vendor detail showing what specifically was reclassified. A pause, brief but noticeable. The approval records are in the financial system, Thomas said. Kevin can pull those for you. As for vendor detail, that's more complicated. Why? I asked. The underlying invoices are in our legacy accounts payable system, Thomas said. We completed an ERP upgrade in July. The old system was decommissioned. Historical detail was archived. I made a note. So the vendor information exists but requires archive retrieval. Correct, Thomas said. It's accessible. It just requires IT support to restore archived databases. That's not instantaneous. How long? I asked. I'll need to check with IT, Thomas said. Probably a week or 2, depending on their project queue. I'd like that initiated, I said. Of course, Thomas said. But Elena, I want to make sure you understand, these reclassifications are technical accounting matters. They don't change consolidated results. They're just internal allocations, ensuring expenses are recorded in the correct legal entity. They change Hexagon's profitability, I said, by $1.095 million. They make it more accurate, Thomas said, by ensuring the subsidiary bears the costs that relate to its operations. I didn't respond immediately. Let the silence extend. I'll follow up with IT about archive retrieval, Thomas said. I'll let you know the timeline. We ended the call. I sat in my office thinking about what I'd heard. Thomas had explained the entries as proper cost allocations, standard accounting practice. Finance reviewing where expenses belonged and correcting the coding accordingly. All of which could be true, but the timing remained interesting. The fact that these corrections had been made in Q2, during the quarter when control procedures had been relaxed, remained interesting. And the fact that detailed vendor information was now archived and required IT support to access remained interesting. Not suspicious, not necessarily, just interesting. I opened my laptop and pulled up the Hexagon acquisition file. Reviewed the parties involved. Vance Global had engaged multiple advisors for the transaction: Cromwell and Associates, legal counsel; McKinsey & Company, strategic advisory; Deloitte, financial due diligence, standard acquisition advisory structure. Large reputable firms, the kind of advisors whose fees would be substantial and whose work would be documented in engagement letters and monthly invoices. But there'd been other consulting spend. I'd seen it in the Q3 budget variance report during the November Audit Committee meeting. Professional services line item showing $700,000 in Q3 expenses, including $125,000 to an entity I'd noted at the time. An entity whose quarterly payments had continued even after the principal behind it had become incapacitated. I pulled up my notes from that meeting, found the name, Blackwood Strategic Partners, $125K per quarter, Arthur's entity, still receiving payments in 2024, still producing deliverables with no named author. I opened the consulting file, reviewed the invoice history, Q1 2024, $125,000, Hexagon acquisition support, Q2 2024, $125,000, post-acquisition integration, $250,000 in fees paid during the first half of 2024 for Hexagon-related work, during the same period when $1.95 million in professional services had been reclassified from parent to Hexagon. I didn't know if the reclassified costs included Blackwood payments, didn't have vendor-level detail to confirm. That information was now archived in a decommissioned system, requiring IT restoration to access. But the timing aligned, the categories aligned. The fact that acquisition-related advisory costs were being moved to Hexagon during the same quarters when Blackwood was billing for acquisition support aligned. I pulled up my email and started typing. Kevin, following up on the Q2 reclassifications, I need the underlying vendor detail showing what specific costs were moved from parent to Hexagon. Thomas mentioned this requires archive retrieval from the legacy AP system. Please coordinate with IT to restore. 1. Vendor invoice detail for the 1.95 members in reclassified costs. 2. Original expense coding showing where costs were first recorded. 3. The allocation analysis supporting the reclassification decision. Let me know estimated timeline. Elena, I sent it at 3:47 p.m. Kevin Park's response arrived Monday morning at 8:52 a.m. Ms. Chen, I've submitted a request to IT infrastructure for archive restoration of Q2 AP transaction detail. The request is in their governance queue for prioritization and cost estimation. Archive retrieval requires formal approval through IT governance board, cost allocation, archive access incurs cloud storage retrieval fees, resource scheduling, database restoration is manual process, IT estimates 2 to 3 weeks for approval and scheduling, then 3 to 5 business days for actual restoration once approved. I'll update you as the request progresses through their workflow. Kevin, I read it twice, 2 to 3 weeks for approval, then 3 to 5 days for restoration, which meant 4 weeks minimum before I could see vendor details showing what had been reclassified in Q2. 4 weeks. A month. Enough time for the December 17 Audit Committee meeting to occur without me having the information I needed to ask informed questions. I opened a reply. Kevin, this is Audit Committee business, financial oversight, not discretionary analysis. Is there a process to expedite IT governance approval for audit-related requests? Elena, I sent it at 9:04 a.m. Kevin replied at 9:47 a.m. Ms. Chen, I've flagged the request as Audit Committee priority. However, IT governance protocols don't have a formal expedite classification. All requests go through the same evaluation process regardless of requester. The governance board meets bi-weekly. Next meeting is November 29th. If approved, then restoration could begin early December. Kevin, November 29, 10 days away. If approved, not when approved, if approved, restoration would begin in December, which meant I wouldn't see the data until after the December 17 Audit Committee meeting. The timeline had been effectively controlled, not through denial, not through refusal, through process, through governance protocols and cost estimation and resource scheduling and bi-weekly board meetings that had already been scheduled months ago. I closed the email and pulled up the IT governance framework document, read the archive retrieval policy. Archive restoration requests require 1. Business justification. 2. Cost-benefit analysis. 3. IT resource impact assessment. 4. Data sensitivity review. 5. Governance board approval. Standard processing time 15 to 20 business days. Standard processing. time, which meant Kevin's estimate of 2 to 3 weeks wasn't delay. It was policy. It was how the system worked. It was the documented process that applied to all archive retrieval requests, regardless of urgency or business purpose. And someone had designed that system, had written those policies, had established governance protocols that introduced weeks of lag time between request and access, had built infrastructure that made historical data accessible, technically, theoretically, but practically difficult to obtain quickly. I pulled up the ERP project documentation, found the implementation timeline, project initiated 2022, planning phase 2022-2023, system build 2023-2024, go live July 1st, 2024, legacy system decommission July 15th, 2024. The old accounts payable system had been taken offline July 15th, 2 weeks after the Q2 reclassifications had been recorded. 1 month after the last transaction I was asking about, the timing could be coincidence. ERP implementations followed planned schedules. System cutovers happened on predetermined dates. Legacy decommissioning was standard post-implementation procedure. But the effect was the same. The vendor detail I needed to understand what Thomas had reclassified in Q2 was now on the other side of a 4-week governance process. Not blocked, not hidden, just sufficiently complicated that obtaining it required formal approvals, cost justifications, and IT resource scheduling that couldn't be expedited even for audit committee purposes. I opened my secure notes, started typing. Q2 reclassifications, $1.095 moved from parent to hexagon. Thomas approved all 3 entries. Timing, during quarter with relaxed reconciliation controls. Vendor detail, archived in legacy system, requires IT governance approval. Timeline, 4+ weeks minimum. Effect, information inaccessible before December audit committee meeting. Pattern, data becomes procedurally difficult to access after the fact. Question, was July 15 decommission date planned years in advance or accelerated? Cannot determine without access to ERP project planning records. I closed the notes and looked out at Manhattan. Somewhere in IT infrastructure's archive systems, in database backups and storage tiers and cloud repositories that required governance approval and cost estimation to access, was vendor-level detail showing exactly what Thomas had reclassified from parent to hexagon in Q2. But that detail was now behind a procedural wall, a wall built from IT governance protocols and resource scheduling policies and bi-weekly board meetings that had been established as standard practice years before I'd ever asked my first question. And I didn't know if that wall had been built deliberately to protect future inquiries or if I was seeing design in what was simply corporate infrastructure management. The only way to know was to wait for IT governance approval, to see if the request was processed normally, to determine if 4 weeks was actually 4 weeks or if complications would extend the timeline further, to see if information would be provided when promised or if additional barriers would emerge. I pulled up my calendar, counted forward. IT Governance Board Meeting, November 29th. If approved, restoration begins early December. If completed, mid-December. Audit Committee Meeting, December 17th. The timeline was tight. Possibly workable if everything proceeded smoothly, possibly insufficient if any delays occurred. I made a note to follow up with Kevin on November 30th to confirm whether the governance board had approved the request, to establish on the record that I was tracking the timeline and expecting completion before the audit committee met. Then I closed my laptop and sat in my office thinking about systems and timing and how information became inaccessible not through destruction, but through the ordinary operation of corporate infrastructure. About whether Thomas Wright had known in Q2 that by July those transactions would be archived, that by November they would require governance approval to access, that by December someone asking questions encounter procedural complexity rather than simple data retrieval, and about whether that knowledge had influenced any decisions about what to reclassify and when. The December 17 audit committee meeting was 3 weeks away. I spent Monday afternoon preparing for it, reviewing the materials I had, mapping what I knew and what I didn't know and what I wouldn't know by December 17, unless IT governance accelerated beyond standard timelines. What I knew, $1.095 million in expenses, reclassified from parent to hexagon in Q2. Thomas Wright approved all 3 entries. Reclassifications occurred during quarter with relaxed controls. Categories were professional services and consulting. Timing aligned with acquisition-related advisory spend. What I didn't know: specific vendors whose costs were reclassified, original expense detail and coding, analysis supporting allocation to Hexagon, whether decisions were technical accounting or strategic positioning. What I wouldn't know by December 17, vendor-level detail archived requires 4+ weeks to restore, invoice-level documentation, verification of whether costs had legitimate subsidiary benefit. The gap between what I knew and what I could prove was substantial. I had pattern, had timing, had approval codes, had amounts and dates and accounting descriptions. But I didn't have evidence that the reclassifications were inappropriate, didn't have proof that Thomas had acted improperly, didn't have documentation showing that expenses had been moved for reasons other than accurate cost allocation. What I had was enough to ask questions, to request explanations, to establish on the record that I was examining these transactions and expected comprehensive documentation, but not enough to act. I pulled up my laptop and started drafting questions for the December Audit Committee meeting. Agenda items to raise: 1. Q2 intercompany reclassification status update. Request: Thomas provides summary of allocation methodology. Confirm IT governance timeline for archive restoration. Establish expectation that vendor detail will be available for Q1 2025 committee review. 2. Professional services spend controls review. Request analysis of all acquisition-related advisory costs. Review approval thresholds for consulting engagements. Discuss whether related party consulting relationships require enhanced disclosure. I read through the draft. The questions were appropriate for audit committee oversight, focused on controls and processes and documentation rather than accusing individuals or alleging misconduct. They would establish a record, would signal that I was tracking these issues, would create expectation that follow-up would occur in Q1 once archive data was restored. But they wouldn't force immediate action, wouldn't trigger investigation, wouldn't expose Thomas or Julian or anyone else to consequences before I understood what had actually occurred. My phone buzzed. An email from Daniel Ward, subject line Morrison & Pierce preservation order status. I opened it. Elena, quick update on the document preservation order we filed for the Morrison & Pierce materials. We received confirmation today that the materials have been secured and will not be destroyed. However, there's a complication. The document custodian, Portman & Associates, has indicated that releasing the materials to you requires 1. Verification of your standing as Arthur Blackwood's legal heir. 2. Confirmation that materials aren't subject to attorney-client privilege that survived Arthur's death. 3. Legal review to ensure disclosure doesn't violate any confidentiality obligations. They're requesting these verifications before providing access. Estimated timeline, 2 to 3 weeks. Let me know if you want to push back on this or accept their timeline. Daniel, I read it twice. The materials had been preserved, wouldn't be destroyed. That was the primary objective. But accessing them now required verification of standing, privilege review, and confidentiality analysis. Another procedural barrier, another timeline extending weeks into the future. 2 to 3 weeks for Morrison & Pierce materials, 4 weeks for IT archive restoration. Both timelines extending past the December 17 Audit Committee meeting, both creating gaps between question and answer, between suspicion and verification, between pattern and proof. I opened a reply to Daniel. Accept their timeline. Preservation is the critical issue. Access can follow. But let them know I expect the materials by year end. This is estate administration, not litigation. Verification of standing should be straightforward. Elena, I sent it and closed my laptop. Sat in my office as afternoon turned to evening and thought about systems designed to manage information flow, about governance protocols and archive policies and verification requirements that introduced weeks of delay between request and access, about whether those systems had been built intentionally to create defensive distance or whether I was seeing conspiracy in ordinary corporate infrastructure, about whether it mattered, because the effect was the same either way. Information existed but wasn't accessible. Questions could be asked but couldn't be answered. Patterns could be observed but couldn't be verified. And 4 weeks from now, after IT governance approval, after archive restoration, after vendor detail was finally provided, I would either find that Thomas had made routine accounting allocations that were technically proper and defensible, or I would find something else. But I wouldn't know which until the systems permitted me to know, until the protocols had been followed, until the timelines had elapsed and the approvals had been granted and the barriers had been procedurally overcome. Until then, I could observe, could document, could prepare, but I couldn't act. The vendor detail arrived December 28 at 3:17 p.m., 4 days before the end of the year, within the timeline Kevin Park had committed to, delivered as promised through standard IT governance protocols. The email was from Kevin. Subject line, Q2 Intercompany Reclassifications, Archive Restoration Complete. Ms. Chen, please find attached the restored vendor detail for the Q2 hexagon reclassifications. This includes original expense coding at parent company level, vendor invoice references, reclassification journal entries, allocation analysis performed by finance. Let me know if you have questions. Kevin, I downloaded the attachment, a compressed file containing multiple spreadsheets and PDF documents. I extracted the files, opened the primary spreadsheet, transaction dates, vendor names, invoice amounts, reclassification entries showing movement from parent G&A expense to hexagon operating expense. I reviewed the data methodically. Professional services firms, advisory consultants, standard acquisition support categories. The allocation analysis memo was dated April, written by Kevin Park, approved by Thomas Wright. The rationale outlined proper cost allocation methodology, defensible language, gap-compliant procedures, but the timing was precise. Direction from Thomas before the quarter began. Execution during the period when monthly controls were suspended. I closed the documents and opened the corporate governance guidelines. Located Section 8.4, Management Accountability and Oversight. When Audit Committee inquiry identifies potential control deficiencies or judgment questions requiring extended evaluation, the committee may recommend temporary delegation of affected functions to preserve investigative independence and prevent interference with review processes. Temporary delegation, not removal, not termination. Authority suspended while questions were being resolved. Section 8.5 specified implementation. Such delegation shall be implemented through board resolution and shall specify scope, duration, and reporting requirements. Affected executives retain employment status and compensation but are recused from decision-making authority in areas under review. Administrative leave without calling it that. Functions reassigned, authority suspended, employment continuing, procedural, defensible. Boring. I spent December 30th drafting the recommendation. Memorandum 2, Audit Committee, David Chen, Margaret Seo. From Elena Chen, Principal. Date, December 30th, 2024. Recommendation for temporary delegation of CFO authority. Following completion of archive restoration for Q2 intercompany transactions, I have reviewed vendor detail and allocation analysis documentation. This review has identified questions regarding professional judgment exercised by the CFO in directing cost reclassifications during a period when standard monthly control procedures were not operating. While preliminary review does not indicate fraudulent activity or policy violations, the questions raised require extended evaluation to determine whether allocation decisions were technically appropriate, properly timed, and consistent with fiduciary duty. To preserve investigative independence and prevent any appearance of management influence over ongoing review, I recommend the Audit Committee invoke Section 8.4 of Corporate Governance Guidelines and temporarily delegate CFO financial reporting authority pending completion of evaluation. Recommended scope: all intercompany transaction approvals, cost allocation decisions, and subsidiary financial reporting oversight. Recommended duration, 90 days or until Audit Committee concludes review. Recommended delegation, financial reporting authority to corporate controller, interim basis. This recommendation is made solely for governance purposes and does not constitute allegation of misconduct. I read it twice. The language raised questions without making accusations, invoked established protocols rather than creating new authority. Framed the action as risk containment rather than punishment. I sent it to David Chen and Margaret Seo at 4:47 p.m. Cover note: please review before January 2nd. I'd like to schedule written consent approval for January 6th. This is time sensitive. On January 3rd, I received an email from David with the subject line, Draft Audit Committee Resolution, CFO Authority Delegation. The resolution was written, formalized, ready for board approval via written consent. The document cited Section 8.4, specified temporary delegation of financial reporting authority from CFO to corporate controller. Duration, 90 days. Scope, intercompany transactions, cost allocations, subsidiary financial oversight. Rationale, pending audit committee evaluation of Q2 allocation judgments, temporary delegation necessary to preserve investigative independence per corporate governance protocols. Effective date, upon board approval. The resolution was scheduled for written consent circulation on January 6. Thomas Wright would retain title and compensation, would be recused from decision-making authority in areas under review, would not be informed until after board approval was secured. The system would absorb the change, authority would transfer, no announcement, no explanation, no confrontation, just governance protocols operating as designed. I spent January 4 and 5 reviewing the implementation timeline. Written consent would circulate Monday, January 6. Board members had 48 hours to approve or object. If no objections by Wednesday, January 8th, the resolution would be deemed approved per corporate bylaws. Authority transfer would occur Thursday, January 9th. Corporate controller would assume interim financial reporting responsibility. Thomas would be notified that morning via formal letter from David Chen as general counsel. The letter would cite Section 8.4, would specify scope and duration, would clarify that employment status and compensation were unchanged, would frame the action as routine governance during pending audit committee evaluation. No accusations, no allegations, no suggestion of misconduct, just temporary delegation pending completion of review. The audit committee would complete its evaluation within 90 days, would determine whether Thomas's allocation judgments had been appropriate, would either restore his authority or escalate findings to the full board. Standard process, documented protocol, defensible at every step. I opened my secure notes, started documenting the sequence for my own records. December 28, vendor detail received December 30. Section 8.4, recommendation submitted to audit committee. January 3rd, resolution read by general counsel. January 6, written consent circulation begins. January 8, board approval deadline. January 9, authority transfer effective CFO authority suspended for 90 days. Evaluation period, January 9th, April 9th. Corporate controller assumes interim reporting authority. Thomas Wright recused from allocation decisions, intercompany approvals, subsidiary oversight. No confrontation, no explanation required. System operates per governance protocols. I closed the notes and looked out at Manhattan. In 5 days, the CFO would lose financial reporting authority, not because he'd been accused, not because he'd been found guilty, but because audit committee inquiry had raised questions that required evaluation, and evaluation required independence, and independence required temporary delegation of the authority being questioned. The logic was circular but defensible. The mechanism was established. The outcome was procedural. On January 6th at 9:47 a.m., I received a notification that the written consent resolution had been circulated to the board. 7 directors, 48-hour approval window, simple majority required. I checked my email throughout the day. No objections, no questions, no requests for clarification. By 5 p.m., 4 directors had approved. By January 7 at noon, 6 had approved. By January 8 at 11:23 a.m., all 7 had signed. The resolution was effective. On January 9th at 8 a.m., David Chen sent a formal notification letter to Thomas Wright via courier and email. I received a copy. Dear Thomas, the Audit Committee has invoked Section 8.4 of the Corporate Governance Guidelines to temporarily delegate certain financial reporting functions pending completion of an evaluation related to Q2 2024 intercompany allocation decisions. Effective immediately, financial reporting authority is delegated to the corporate controller on an interim basis. You are recused from approval authority over intercompany transactions, cost allocations, and subsidiary financial oversight. Your employment status, title, and compensation are unchanged. This delegation is temporary and will remain in effect during the evaluation period. approximately 90 days. The audit committee will complete its evaluation and provide findings to the full board. Depending on those findings, your authority will either be restored or the matter will be escalated for further board consideration. This action is being taken solely to preserve investigative independence during the evaluation process and does not constitute an allegation of misconduct. Please contact me if you have questions about scope or process. David Chen, General Counsel. The letter was clinical, procedural. It explained nothing about what had triggered the evaluation, provided no detail about what questions were being examined, simply stated that authority was being temporarily delegated per established governance protocols. Thomas would read it, would understand that he'd been sidelined, would know that audit committee evaluation was underway, but he wouldn't know what I'd found, wouldn't know what evidence existed, wouldn't know whether this was routine governance or the beginning of something larger. And for the next 90 days, he would have no authority to influence financial reporting decisions, approve intercompany transactions, or oversee subsidiary operations. The system had absorbed the change, authority had transferred. The CFO retained his title, but not his function. That afternoon, I received another email, this one from Patricia Ward on behalf of Daniel. Subject line, Document Access Update, Morrison & Pierce Archive. Elena, Daniel asked me to inform you that Portman & Associates has completed verification and approved release of the Arthur Blackwood materials. However, access has been delayed due to an administrative issue. The archive retrieval requires coordination with a third-party storage facility in New Jersey. That facility is currently undergoing system upgrades and has temporarily suspended document access pending completion of their migration to a new records management platform. Estimated restoration of access, late January, early February. Daniel is monitoring the situation and will update you when the facility confirms availability. Patricia, I read it twice. The Morrison & Pierce archive was being delayed, not denied, not destroyed. Just procedurally inaccessible due to system upgrades at a third-party facility. Another barrier, another timeline extension, another situation where information existed but couldn't be accessed immediately. The request was acknowledged, not approved, not denied. Access was pending review by outside counsel. Timeline undetermined. The archive existed. That was all they would confirm. No estimate, no prioritization, no escalation path. Another dependency introduced, another process interposed. The system had absorbed the action and slowed everything else down.